Welcome to the deep dive. Today we're looking at a single day, December 18th, 2025, that honestly feels like it's split between two completely different realities.
It really does. On the one hand, you have the U.S. markets just celebrating.
Absolutely surging, indexes are bouncing back, and it's all because of this surprisingly good inflation news. You could look at that and think, okay, the soft landing is locked in.
But then you look just beneath that surface, that sort of euphoria, and you find these three really distinct threats that almost make that positive data meaningless.
Exactly. We've got sources detailing compromised data, a major central bank divergence, and a military escalation that's, frankly, getting pretty serious.
Right in the Western Hemisphere.
So our mission for this deep dive is to try and pull these very different threads together. We need to unpack why that good inflation news is, well, inherently flawed.
And why the Bank of Japan's meeting tomorrow could, and I'm not exaggerating, potentially trigger a global financial event.
And how all of that connects to this geopolitical flashpoint in the Caribbean, which is starting to feel a lot like the 1960s.
So I think the essential question we're asking is, can the market really be celebrating cooling inflation when the data itself is shot and there's genuine, existential military risk on the table?
Okay, let's start where the market started, the inflation report.
Yeah.
The delayed November data finally dropped, and on the surface, it looks fantastic.
It really did. Headline CPI came in at just 2.7% year over year. The consensus was, what, 3.1%?
Yeah, way below. And even better, core CPI hit 2.6%. That's the lowest reading we've seen since mid-2021. I mean, that's a huge psychological win for the Fed.
It looks like a huge win, yeah. It supports the whole idea that the Fed will keep cutting rates into early 2026. But, and this is a massive asterisk, we have to treat these numbers with deep skepticism.
Because of the government shutdown.
Exactly. That shutdown from October 1st to November 12th.
And this is where we really get into the weeds of data quality. That lapse didn't just delay the report, it created a permanent hole in the data.
A permanent gap. Our sources confirm there are no current population survey. That's the CPS estimates for October 2025. A whole month of economic history is just gone.
Wow. And if you don't have October,
then the quality of what comes next is severely degraded. Which brings us to the November labor market figures.
Right. The unemployment rate jumped unexpectedly to a four-year high of 4.6%.
And normally, a softening labor market supports rate cuts. But the problem is the Fed just can't trust this number.
Hold on. I remember reading about this. The non-farm payrolls number actually came in better than expected, right?
Yeah.
It added 64,000 jobs.
It did.
So how can we be sure the unemployment rate, the bad news is unreliable, but the jobs number, the good news, is okay? What actually broke in the calculation?
That's the core problem. The unemployment rate relies so heavily on consistency in the survey population. I mean, the Bureau of Labor Statistics, they usually have a 75% overlap of the same sample group month to month.
So they can fine-tune the estimate.
Precisely. But when October became a ghost month, they lost that critical anchor.
So they had to estimate November using data that was already 2 months old from September.
That's exactly what happened. They had to modify the formula, and it's now reflecting only a 50% sample overlap with September. Think about it. Instead of fine-tuning, they're forced to take a much broader, less precise guess.
So when Fed Chair Jerome Powell looks at that 4.6% unemployment figure, is he seeing a real alarm bell, or is it just static?
It's mostly static. It's a very fuzzy estimate. The missing data widened the statistical margin of error. Our sources show the change needed for the unemployment rate to be statistically significant is considerably higher now.
So a move that might have been a big deal a few months ago is now basically just random noise.
Statistically, yes. The Fed is essentially flying blind on the labor market right now.
And it sounds like it created a bureaucratic nightmare for the people actually collecting the data, too.
Oh, it did. I mean, statisticians rely on what's called dependent interviewing. If you were unemployed last month, they just update your status. Simple.
But with no clean October data.
They had to start everyone's story from scratch in November. They had to manually re-ask every single job seeker about their entire duration of unemployment. It's a massive disruption, and it just adds to the noise that policymakers are struggling with.
So the Fed is stuck. Cooling inflation is good, but their key labor market indicator is totally tainted. And that data chaos leads us straight to the global monetary tightrope.
It does. While the U.S. is wrestling with this, global central banks are all going in different directions. The Bank of England just cut rates.
Right, by 25 basis points.
And the European Central Bank held steady. But the highest stakes in the entire financial system right now rest with the Bank of Japan.
Their decision is coming up on December 19th. What's the market expecting? And why is a Japanese rate hike, from 0.5% to maybe 0.75% such a massive global event?
Well, the futures markets are pricing in a 95% certainty of a 25 basis point hike. And if that happens, 0.75% would be the highest Japanese rate in nearly 30 years.
A historic shift.
A huge departure from decades of near zero rates. And that immediately triggers the threat of the yen carry trade unwinding.
Okay, so let's break down the yen carry trade for everyone listening. Why does Japan raising its rate by a quarter point in Tokyo threaten a retirement account in, say, Texas?
It's basically the ultimate leveraged global bet. For years, you could borrow yen for next to nothing. So global investors, hedge funds, you name it, they borrowed trillions of yen at these super cheap rates.
And then what?
They immediately converted that money into dollars or euros to buy things with higher yields. U.S. stocks, emerging market debt, real estate, crypto. It's a massive stream of capital that has fueled global asset prices for decades.
So if the BOJ raises rates, the cost of borrowing that yen goes up instantly.
Right, and everyone who borrowed it is forced to pay it back before it gets even more expensive, which means they have to sell all those global assets to get yen.
And that could cause a flood of selling.
Exactly. Analysts are ringing loud alarm bells. They're warning that a panicked unwinding could trigger a serious sharp correction. We're talking a potential 10% to 12% drop in the S&P 500.
A 12% drop in the S&P 500 just because Japan moves its rate a quarter point.
Yeah.
Is it really that leveraged?
It's genuinely that leveraged. The capital involved is in the multi-trillions. And history kind of confirms this, especially in the most speculative assets. Previous BOJ tightening moves have correlated with huge turbulence in crypto.
Really?
Yeah, some analyses suggest Bitcoin could face a 20 to 25% drop if this unwind gets aggressive. So the BOJ is making a domestic decision, but the ripple effects are absolutely global.
That is a massive macro pressure.
Yeah.
And it's the backdrop to what is suddenly a major military escalation, practically in our own backyard.
Yeah, we have to shift from that quiet threat of financial leverage to the very acute threat of conflict. This pressure cooker has been building in the Caribbean.
You're talking about the total and complete blockade President Trump ordered against sanctioned Venezuelan oil tankers.
And they were not subtle about enforcing it. The U.S. Navy assembled what's being called the largest armada ever in South American history just to choke off those exports.
It worked.
The impact was immediate. Crude flows from Venezuela just plummeted from over 1 million barrels per day down to about 258,000. And that oil, which mostly goes to China, has been severely restricted.
And that, of course, brought a very sharp and provocative response from Moscow.
It did. Russia's foreign ministry explicitly warned the U.S. against making a fatal mistake and said the blockade could lead to, and I'm quoting, unpredictable consequences for the entire Western Hemisphere.
That's some pretty chilling rhetoric.
It is. And then came the actual military countermove, confirmed today, which really got the world's attention.
The Oreshnik missile.
Russia deployed its nuclear-capable Oreshnik intermediate-range ballistic missile to Belarus.
And this isn't just any missile, right?
Not at all. It's boasted to be impossible to intercept, travels at hypersonic speeds up to Mach 10, and Russian state media claims it can hit NATO headquarters in Brussels in 17 minutes. This immediately changes the defense posture in Europe.
But the truly unnerving part, the detail that echoes the 1960s, is where else these weapons might end up.
That's the real threat. Russian lawmakers have been openly talking about supplying the Oreshnik and other missiles like the Kallier to friendly countries.
Specifically naming Venezuela or Cuba.
Specifically naming them. It's a clear attempt to raise the nuclear stakes right in the Americas, basically challenging the U.S. blockade by threatening escalation on America's doorstep.
So we literally have the ghost of the Cuban Missile Crisis floating over the Caribbean, a potential global financial crash hanging on a decision in Tokyo, and yet the S&P 500 is surging. How do you square that?
It's because the market often just focuses on the most immediate, tangible thing. And today, that was inflation relief. The positivity was clearly driven by the tech sector, which has its own thriving narrative right now.
Artificial intelligence.
AI hardware demand. Look at Micron Technology. The stock soared over 10% today after they posted surprisingly strong earnings.
All because of demand for their memory chips.
They're high-bandwidth memory chips, which are absolutely essential for AI data centers. That one piece of good news injected life into the whole sector. NVIDIA, AMD, they all rebounded as investors just grabbed onto that clear, profitable signal.
So amid all the macro chaos, investors are just clinging to tangible corporate growth stories.
Exactly. We also saw activist investor Elliott Management take a huge billion-dollar-plus stake in Lululemon, trying to push for a new CEO. That's MicroStrategy winning out over macro fear, at least for a day.
And what about commodities? How are they balancing this?
Well, oil prices rose a bit, sure, because of the Venezuelan blockade.
Yeah.
But analysts are already forecasting a decline in 2026, assuming things don't blow up.
And gold. Gold.
Gold, the classic safe haven, is still supported by the idea of rate cuts. Goldman Sachs thinks it could climb all the way to $4,900 an ounce by December 2026.
But if we look at the ultimate risk-on asset crypto, we see that fragility you mentioned earlier. Bitcoin is near $87,000, but it's testing a critical level, isn't it?
A critical fault line at $81,300. Technical analysts see this level as absolutely crucial because it aligns with key long-term moving averages. The stakes are incredibly high, especially with the yen carry trade risk hanging over everything.
So holding that level is the launch pad for a push higher.
Right, a push towards $95,000 by mid-2026. But if they breach it,
What happens?
breaching it could trigger cascading liquidations, all those leveraged positions being forced to sell. That could easily push Bitcoin down towards $70,000 or even lower.
And you can feel that tension in the market sentiment.
Oh, absolutely. The Crypto Fear and Greed Index is sitting at a chilling 17. That signals extreme fear, even as the price is sort of stabilizing just above that fault line.
And it's not just Bitcoin, is it?
No. We're seeing major weakness in altcoins. You see these head and shoulders patterns emerging, which suggests speculative capital is pulling back from the riskiest corners of the market. It's a clear signal of caution.
So let's try to synthesize all of this. The market's relief from soft U.S. inflation is being totally undercut by the statistical noise from the shutdown. The Fed is operating on a faulty foundation.
And that statistical risk is then compounded by the acute macro threat of the yen carry trade reversal, which could easily trigger a 10 to 12% market correction.
And layered on top of all of that is the immediate threat of a maritime conflict in the Caribbean, coupled with Russia deploying its nuclear-capable Oreshnik missile.
We've seen how a lack of data, that missing October report, has compromised the very foundation of economic policymaking for the Fed. So you should consider this. When that foundation of reliable data is compromised, do investors turn to other things, like technical analysis, Bitcoin's $81 3K line, or specific corporate earnings like Micron's AI boost, not just for profit, but as a desperate attempt to find clarity in a world where fundamental truth is fractured?